Hi everyone, welcome to episode 2 of Liquid Loans Behind the Scenes. In this episode, we're going to keep it short and sharp. I'm going to introduce you to the two tokens that form the Liquid Loan protocol. So let's dive straight in. We'll keep this nice and quick so you can move on to the next episode. But we've got two tokens. We have one called USDL, which is a stablecoin. And then we have one called loan, which is a fee earning token. So it's the secondary token of the system. It plays a very important role, and I believe it'll be a very, very valuable token because it is actually going to generate you a yield. So let's first of all jump back to USDL, and then we'll have a chat about loan. So USDL we said is a stable coin, and it's a decentralized stablecoin. So the protocol, i.e. you, when you interact with the protocol, actually issue this stablecoin. This is important because it means there's no central company that is issuing these stablecoins. Therefore, there's no counterparty risk. You don't have to trust that they've got the US dollar cash or equivalents to back up the value of that stablecoin. The protocol handles all of that, so you will always be able to redeem one USDL token for $1 worth of pulse. So it's always collateralized and backed by the pulse in the system. So it's very, very important. The other thing is, with a lot of centralized stablecoins, the way the price peg is maintained is A, by trust in the market that it's worth $1, and by B, the company behind it making sure they do have the correct amount of assets to back up the token issue, the token supply. And now how do they do that? Well, they have to rely on external auditors to come in and audit their books and check that they've got the right amount of cash or cash equivalents, and they've only minted so many coins that relate to that. Now, the other thing is you can't actually redeem, you can't redeem something like USDC for the underlying dollar. That just doesn't exist in the system. The central controlling party does all of that on your behalf, and you can never ever redeem for the actual underlying dollar. Something like liquid loans, the protocol holds the collateral in place, but you can always redeem that USDL for that collateral that underpins it. Okay, so really important. So in this system, we have USDL, and when you actually create a loan, you mint USDL. So we think this is going to be as important a feature as the actual lending feature. So the lending feature is really important because it means you potentially never have to sell your pulse, which is a massive tick. But this also means the community, who are the users and the owners essentially of Liquid Loans, the protocol, are the custodians. You are the reserve bank. You mint this stablecoin into existence. So it's a community-owned stablecoin. I think that's really important, and I think it's going to play a very, very big role on the Pulse ecosystem, and possibly even out into other EVM-compatible chains as well. But definitely on the Pulse ecosystem, that's our view for liquid loans. We want to see the community own the stable coin that is issued on the network. Hopefully we see that stable coin in all the liquidity pools, trading against things like Hex and Pulse and a myriad of other things. That's our vision for this protocol. Okay, the loan token side of things. So this is a token that's issued as a reward by the system for people that actually engage with the system. And we'll delve into that a little bit more, but just in a nutshell, if you support the stability pool, so if you support this pool here, then you'll get issued the loan token. Now the important thing about the loan token is it can be staked, and you get a share of all the fees that are generated in the system. So it's a yield producing productive asset within the system. So it'll have that speculative value, but it'll also be a yield producing coin. So it's actually, the more the system's used, the more valuable that token will become, because the more fees are generated in the system, and the more fees that are generated in the system, the more value goes back to the holders. Now, what do you get? So in return for staking the loan token, you will get USDL, and to a lesser extent, you'll get Pulse. Okay, but the primary thing you'll get paid out in is USDL. So you get actually issued the fees from people taking loans as USDL to your wallet, or you can claim that. Okay, that's it. Going to keep it really short and sharp. We kept that to 5 minutes. So now you understand what the USDL stablecoin token is in the system, and you understand what the loan token is in the system as well. I will, now that you understand those, in videos to come, we'll dig into that a lot more. But as long as you've got that general overall view of it, we'll be able to talk more about the stability pool and the loan staking, and hopefully that will make a little bit more sense as we move forward. Okay, I'll catch you all in the next episode. Hopefully that was very helpful.